In this video, we're going to take a close look at the M&A process and specifically the buy-side strategy formulation. The mergers and acquisition process is multifaceted and strategic, and it involves a series of steps, each of which is critical to achieve a successful transaction at the end of the day. The process can be viewed from both sides, both the buy side representing the entities seeking to acquire or merge with another company, and the sell side, which represents companies aiming to be acquired or seeking merger partners. The process for both sides is intrinsically linked, with actions on one side often mirroring or complementing those on the other. So from the buy-side perspective, firms start by delineating their strategic objectives, which then include or might include expanding market reach, acquiring new technologies, or achieving economies of scale. This phase involves identifying potential targets that align with these strategic goals. This video is part of a series covering the M&A process, which you will find in my M&A process playlist, so definitely go and check that out. Stay with me until the end. I will share a personal strategy for identifying and shortlisting buy-side targets, which I've used to great effect personally in my career. So let's look at the buy-side strategy formulation process and how it all works. We'll start by defining strategic objectives. The management role here is to clearly articulate the strategic objectives behind pursuing an M&A transaction. Now, these objectives may include expanding market presence, acquiring new technologies or products, achieving cost synergies, diversifying product lines, or entering new geographic markets. The advisor's role, and I'm going to keep flicking between the management and the advisors to give you the contrast, and obviously I spoke mainly or acted principally as an advisor in my career. The advisor's role is to challenge and refine the strategic objectives to ensure they are aligned with the company's long-term vision and market realities. We act as a reality check on what's going on. Advisors bring an external perspective, which hopefully will validate or adjust any strategic assumptions. Step 2 is to assess internal capabilities. Here, the management conduct an internal assessment to understand the company's strengths, weaknesses, opportunities and threats, a classic SWOT analysis, which is Business Strategy 101. This helps to identify areas where an acquisition can complement existing capabilities or address gaps. Here, the advisors provide a third-party assessment of the company's internal capabilities and market position, offering insights into how an acquisition could enhance competitive advantages or mitigate weaknesses. If you know your client company's business, and you should do, then you should be able to have a view on the sorts of strategic moves they should be making. Step 3 is the market and industry analysis. Here, the management perform a thorough analysis of the market and industry, often with the help of external consultants, and they're trying to identify areas which are ripe for consolidation, emerging technologies, or sectors with high growth potential. The advisor's role here is to leverage their industry expertise and market research tools to offer deep delve into the market dynamics, competitive landscape and potential regulatory implications of an acquisition. Now, if you're a sector expert like I was, then you will be speaking to lots and lots of companies. I did 218 meetings in one 9-month period in 3 continents. So you were getting a very broad perspective of what's going on. Internally in the firm, you also have research analysts who have huge industry knowledge. And without giving away your client's strategy, you obviously want to be picking their brains and reading everything that they're writing about the sector so that you have, a more informed and broad-minded view than the management might have. Step 4 is then to develop the acquisition criteria. Here, management look at their strategic objectives and their market analysis, and they come up with specific criteria for potential acquisition targets. These criteria may involve company size, geographic location, financial health, market share, technological capabilities and cultural fit. And these criteria were, if you like, the benchmarks that we were given as advisors to go out and find targets that met these criteria. So the role here for the advisor was to assist in refining the criteria to make sure they're realistic and aligned with market opportunities. I had one North American client who wanted to make European acquisitions, but they could never get their mind around the price they had to pay in the European market. They always felt the market was too expensive, and it didn't matter what ideas we put forward, they always came back and said no, it was too expensive, they wanted to pay a lot less, and that just wasn't feasible or realistic, and we had to tell them that. Advisors can also help in setting the priorities around the criteria to guide the search process effectively. Step 5 is the financial modelling and analysis. Here, of course, the management undertake financial modelling to understand the potential impact of an acquisition on the company's financial statements. Essentially, they put together a merger analysis, which includes the impact on earnings accretion or dilution, which is obviously critical in the public markets, the impact on cash flow, and any criteria they have for the ROI on the transaction. But advisors are often much better at financial modelling than companies have a lot more practice at it. So we can provide sophisticated financial analysis and expertise which projects the financial outcomes of potential acquisitions, including valuation ranges, synergy estimates, and risk-adjusted returns. So we tend to go beyond that, and we're also looking at the valuation side of the transaction, not just the merger side of the opportunity. In step 6, we look at risk assessment. Here, the role for the management is to identify the potential risks associated with the M&A strategy, including integration challenges, cultural mismatches, market execution risks, and regulatory hurdles. But the advisor is also conducting risk assessments from an external perspective, highlighting industry-specific risks, antitrust considerations, and potential deal breakers. And often these are things that come out in the due diligence, and where the advisor has to have their radar set on high alert to find things as they come up and bring them to the attention of management if they think it's going to be a problem and a potential deal breaker down the road. Much better to solve these problems quickly early on than to try and argue over them at a closing meeting. And of course, advisors can also suggest risk mitigation strategies to deal with these problems. Step 7 is resource allocation. Now, the management here determine the resources internally, the financial, human, and operational resources they have in their company that they can allocate to pursuing M&A opportunities to ensure that the acquisition strategy is feasible and sustainable. And of course, this often involves allocating people like the finance director, the CEO, to dedicating time to the transaction process to make sure they can stay on top of it. But from a financial advisory point of view, you advise on the structuring of the deal, including the financing options and optimizing the resources of the business for the acquisition. And clearly, having the wherewithal, the financial resources to do the transaction in the first place is absolutely critical. No seller will look at you for more than 5 minutes if you can't show them categorically that you can fund a transaction. And of course, advisors also assist in planning for the integration phase to ensure adequate resources are in place to make sure the transaction is successful after it closes. Step 8 is the strategic roadmap development. And here we're talking about planning the acquisition process. You need to have a roadmap that outlines the key steps from target identification through integration, setting clear milestones and timelines for the M&A process. But of course, it's the advisor's role to actually coordinate all this and run the transaction. So apart from just contributing to the roadmap with insights and identifying potential pitfalls, regulatory milestones and any other benchmarks, they need to make sure the transaction runs smoothly and to a timetable. And that means coordinating with all the other parties, all the other advisors on both sides of the table to make sure the transaction happens in an effective and timely manner. And that is one of the most critical roles of an advisor in the M&A process. Stakeholder engagement plan needs to be considered as well. Now, this is all about communication. The plan to engage with the key stakeholders, which may include the board members, the investors, employees, and regulatory bodies to ensure support for the M&A strategy. However, the timing of this messaging and the content of this messaging is critical, and it's very different for very different parties. You don't tell investors 6 weeks before a deal that you're going to close a major acquisition. But you do need to tell your employees the day after the acquisition is announced exactly what it's all about and how it's going to affect them. And that's absolutely critical. And here the advisor can come to the fore, providing guidance from their experience on the best practices for stakeholder communication and engagement. And I've done this many times to make sure that announcements, both public and internal announcements, are made effectively and the right thing is said in the announcements. So strategy formulation is critical as it lays the foundation for the entire M&A process. It requires a collaborative effort between management and advisors to ensure that the M&A strategy is well conceived, grounded in reality, and capable of delivering the desired strategic outcomes. Now, I promised you a personal strategy to identify buy-side targets. Use trade association member lists and partnership groupings to identify companies operating in the targeted strategic space. Now, I'll give you an example. I was working for a UK company. They wanted to acquire a German SAP implementation company, an IT services company. So I looked at all the IT services partners of SAP in Germany, and there were more than 300 of them. From that, I identified 2 targets that met our strategic criteria, and we actually ended up buying one of them. So if you enjoyed this video, please subscribe for notifications on further videos. And if you haven't watched it, then definitely watch my mergers and acquisitions overview of the M&A process video, which has been viewed over 85,000 times. That'll give you a high level view of the M&A process, and I'm going to be delving into much more detail in this series of videos on the M&A process, which will back that up. So that's definitely the one to watch next, and I'll put a link to it on the screen. And look out for, in my M&A playlist, the next set of videos which will follow up after this, taking you through in a very in-depth way through the M&A process. So I hope you enjoyed this video. Thank you very much for watching, and I'll see you in the next one.